Hello and welcome to Session 13 of the Basic Tax course. With Session 13, we begin Level 2 of the Basic Tax course, and you're going to notice there's a difference in the types of topics that are being covered and really the type of thinking and logic that needs to be applied. In the first half of the Basic Tax course, we really did focus mainly on rules. You know, this is the rule, these are exceptions to the rule, these are exceptions to the exception, and lots of that, just over and over and over again, just rule, 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 with no coherence or logic behind any of it. Well, beginning with today's class, we're moving into a different type of tax law application, beginning with the basis of assets. And the basis of assets is a very important session. It is the foundation for all of the sessions that are going to follow this session. And it is relevant to both individual investment income as well as the business side of things. When we get into depreciating assets and selling business assets, basis is an incredibly important item. And many preparers really just don't get basis at all. Even after being in the industry for many years, I run across tax preparers who have absolutely no idea how to calculate basis in something. So I'm going to do the best job I can today of teaching you how basis works. And after today's class, we're going to be building on into other subjects of business law, including rental income and expenses, self-employment income and expenses, selling off of business assets, those types of things. Depreciation, of course, is a big one as well, and actually depreciation is one of my favorite topics. So let's begin with Session 13. You'll notice that we have quite a bit listed for reading assignment for today's class. It would be a little bit overwhelming with these more advanced sessions to really read everything in these publications or even attempt to absorb it. So these items that are listed outside of Pub 17, but what I mean by that is, of course, go ahead and read the pages in Pub 17 as we say. But if you want additional information or if you want to do additional research on any of the topics covered in today's session, then the additional recommended reading is Publications 551 and Publication 525. Let's get on with today's class. And the first thing we're going to look at is the definition of a capital asset. It's important to know what a capital asset is, because if you sell a capital asset, you may be able to apply capital gain and loss rules. So in order to apply those rules, that is the capital gain and loss rules, you have to be able to identify when you have a capital asset. The tax code says that all assets are capital assets unless they are one of the following. So another way to put it is all assets are capital assets except when they're not. So, what is not a capital asset? Well, stock or inventory held for sale to customers. So if you walk into a retail store and you see items on the shelf, those are not capital assets to the store. But if you buy them, then they become a capital asset to you because they're not held by you for sale. Another example of an inventoriable item would be in a manufacturing business where you're purchasing product that you use to manufacture another product. And those inventoriable products and the finished product that you have manufactured, both of those are not capital assets. Also not a capital asset is accounts or notes receivable acquired in the ordinary course of a trade or business, depreciable property used in a trade or business, real property used in a trade or business, copyrights, literary, artistic, or similar property created by personal efforts or acquired from the creator under circumstances that entitle you to the creator's basis in the property. So what this means is, let's just suppose that you're a musician and you compose a song. Well, that song is not a capital asset to you. And if you give it to a friend or a relative, then it's not a capital asset to them either, because it was a product of your labor. Conversely, if you produce a song and then you sell the rights to that song to a music company, when a song arrives at that music company, that song is now an asset of theirs. So that's essentially what goes on. It depends on who makes the asset and the purpose of the asset. If an asset is held for use in a trade or business, it's typically not considered to be a capital asset, although we will see as we move along, even when an asset is purchased by a business and used in a business, in the end it can still receive some capital gain treatment. But the treatment that it receives is still different than the type of capital gain treatment that is given to assets that are owned by individuals. Also, what is not a capital asset is the U.S. government publications that are, well, free. So Pub 17, it's not a capital asset because it's a U.S. government publication and it was free. Now, all of the following assets are examples of capital assets. Personal use property, including dwellings, cars, furniture, jewelry collections, etc. Investment use property, including land, stock, municipal and corporate bonds, collectibles, antiques, etc. And business use property, but only certain intangible personal type property such as goodwill or franchise, plus any net Section 1231 like-kind exchange gain from the sale of business use assets. So we've identified what is and is not a capital asset. Now we're going to go and talk about what makes up the cost or basis in an asset. Cost basis of property. Your cost basis in property is usually your purchase price. However, any of the following situations can give you a different cost basis. You received your property as a gift, or you inherited your property, or you received property in exchange for services rendered, or you paid transfer taxes and insurances or other closing costs upon acquisition of your property that you could not or chose not to expense. So let's look first at property you received as a gift, because if you received property as a gift, that means, well, you didn't purchase it. And if you didn't purchase it, well, you might have to do a little bit of extra work to figure out what your cost basis is. So if you receive property as a gift, you must know its adjusted basis to the donor just before it was given to you, its fair market value at the time it was given to you, and any gift tax paid on it. You then apply one of the following two rules to calculate your gain or loss when you sell or dispose of the gift. Number one, if the fair market value at the time of the gift is less than the donor's adjusted basis, then to figure a gain, your basis is the same as the donor's basis. And to figure a loss, your basis is the fair market value of the gift when you received it. Or two, if the fair market value at the time of the gift is equal to or greater than the donor's adjusted basis, then to figure either a gain or a loss, your basis is the same as the donor's adjusted basis. Your basis in a gift may increase or decrease because of certain adjustment items which take place after you receive the gift. These adjustment items can include allowable depreciation, casualty or theft losses, capital improvements you make to the property after you acquire it. You should note that these rules are designed to minimize the loss and maximize the gain for the IRS tax purposes. So if you dispose of a gifted property for a price that falls between the basis and the fair market value at the time you received the gift, then there is no profit or loss on the disposition. So what I've got here are some student exercises for you to work through. And at this point, would you please push pause on the video playback and take a look at these student exercises 1 through 5. Do the best job you can of selecting the correct answer. It shouldn't take you more than, say, 5 minutes. And when you are finished, please resume video playback and we will go through these together. So let's take a look at these problems, beginning with number 1. Jackie received a gift with a fair market value of $100 and a basis to the donor of $150. Jackie then sells the gift for $180. What is Jackie's profit from the sale? Well, because the fair market value on the date of the gift is less than the cost, we're going to go with the rule that says if the fair market value is less than the cost and the asset sells at a gain, you go with the cost. And if the asset sells at a loss, you go with the fair market value. In this case, the gift has sold for more than either the cost or the fair market value, and we're going to go with the actual cost. So the gain on the gift will be the difference between $150 and $180, and that is $30. Moving on with question number 2. Henry received a gift with a fair market value of $150 and a basis to the donor of $100. He sells the gift for $180. What is Henry's loss from the sale? Well, in this situation, we have a fair market value on the date of the gift that is greater than the cost. So we're going to use the cost, whether we sell at a gain or a loss. In this case, it sells at a loss, so we're still going to go with the cost. And if he sells the gift for $80 and his cost is $100, we're going to have a loss from the sale of $20. Number 3, Sally received a gift with a fair market value of $60 and a basis to the donor of $80. She sells the gift for $70. What is Sally's profit or loss from the sale? Well, here we have a fair market value on the date of the gift that is less than the cost, but it sells for a price that is greater than the fair market value and less than the cost. So since it sells somewhere between the fair market value and the cost, and the fair market value on the date of the gift was less than the cost, then in this situation, no gain or loss is realized. And therefore, A is the correct answer. Number 4, George received a gift with a fair market value of $120 and a basis to the donor of $100. He sells the gift for $150. What is his gain from the sale? Well, in this situation, again, we have a fair market value that is greater than the cost on the date of the gift, and therefore, whether it sells at a gain or a loss, we're still going to use the cost. In this case, he sold it at a gain. His cost is $100. He sells for $150, so B will be the correct answer. Finally, number 5. Jack received a gift with a fair market value of $100 and a basis to the donor of $150. He sells the gift for $150. What is his loss from the sale? So here we have another situation where the fair market value on the date of the gift is less than the cost. So if it sells at a loss, we're going to use the fair market value because the fair market value is going to minimize the loss that the recipient of that gift is allowed to claim. So if the fair market value is $100 and it sells for $50, then the correct answer is a loss of $50. Now we move on to a different type of basis calculation, and it has to do with inherited property. There are a lot of special rules about inheritances, including the rules surrounding the basis of an asset that you inherit from someone. Now, if the decedent, that is the person who died and left you the inheritance, died before 2010, if you acquire that property through inheritance from a decedent who died before 2010, your cost basis is the fair market value of the property on either on the date of death of the decedent or 6 months after the date of death of the decedent. The decedent's estate establishes which valuation date shall be used, and once the estate chooses a valuation date, that same date is used for all assets of the estate. The date property is distributed to the beneficiaries has absolutely no bearing on the issue of cost basis. Now, if the decedent died after 2009, that is, at some time in 2010, then we have a different rule. If you inherited property from a decedent who died in 2010, special rules may apply for calculating your cost basis. There are 2 options for how executors treat the assets in estates of decedents who died in 2010. The estate executors can choose to apply the same estate tax rules for property acquired from a decedent who died before 2010, as we just described above, or a special election that elects out of the estate tax rules for 2010 and uses the modified carryover basis rules that fall under Section 1022. Now, essentially, 2010 was the only year in history where there was a repeal of the estate tax. That particular law that was leading towards a complete repeal of the estate tax was signed in by President Bush at the beginning of his administration. And over time, there were a lot of different people, many of them very wealthy. For example, Bill Gates and his family opposed this rule because the estate tax does serve a function for society, and although some people disapprove of it, there are many people out there who see the value in it, and it was essentially the founding fathers of our nation who decided to bring in the estate tax. So it's not something new. It's been around a long time. But in any event, under Bush, the estate tax was set to be repealed in the year 2010. And what that meant was that if you died in 2010, there would be no estate tax on any of your assets. Well, in 2010, President Obama was pushing through a package to help stimulate the economy, and a big discussion going on with that economic stimulus package was the estate tax. And in the end, to get it through Congress, and get the Republicans participating, it was decided that the estate tax could remain in place for 2010 for those estates where a person had actually died in 2010, and that there would be some expansions or higher limits on the amount of value an estate could have after a person dies for years after 2010. In any event, 2010 is just a weird year. And really for 2009 and all earlier years and 2011 and all later years, the estate rules are pretty much what you see up here. That being that you use the date of death of the decedent or 6 months after the date of the death of the decedent to establish the cost basis in an asset. So what I'm getting at here is if a person died in any year other than 2010, you're going to follow these rules right here. That is, on the date of death of the decedent or 6 months after the date of death of the decedent, the estate will set a valuation. And all assets held by the estate on that date are given a value based on the fair market conditions on that day. If you have a decedent who died on December 31st, 2009, and that decedent's home had a particular fair market value on that date, whoever inherits that house is going to have a cost basis in that house equal to the fair market value of that house on the date the decedent died. Now, it is possible for the estate to pick a date that is 6 months later. And so in that case, you might go to the fair market value on June 29 of 2010, because that would be 6 months later. But most estates are so small, no one stops to think or plan what kind of a valuation or what valuation date should be chosen. And therefore, in most cases, you're really just going to fall on the date of death. Now, there's one exception, of course, that's the year 2010. And what happened for 2010 is executors and administrators of estates have the option to elect into the same rules for 2010 that were in place for all other years. Or they can elect to use the repeal of the estate tax for 2010. And there can be many, many reasons not to elect the latter option. In many cases, the beneficiaries of the estate are much better off under the stepped-up basis rules that were in play before 2010 and for all years after 2010. So essentially, what happens is if you get a valuation on an estate as of the date of death, and you've got a person, say, who died at the age of 80 and has, left behind to his children all of the assets that he accumulated in his lifetime. Those assets are going to have probably some significant value to them in most cases, but are they going to be more than $1 million, $2 million for most Americans? Probably not. Now, how are you going to go back in time and figure out what that decedent paid for those assets? Is there any way to even begin to figure out what a decedent paid for an asset 30, 50, 60 years ago? The answer is that's almost impossible. So these stepped-up basis rules really do help. It doesn't matter what the decedent paid for an asset. What matters is what it was worth on the date of death. And for virtually every situation you'll ever deal with on inherited property, you simply need to turn to the date of death. So if you have an heir who inherited stock on, say, January 30th, 1998, and you want to know what their cost basis in that stock is, well, you're going to go look to see what that stock traded for on that date back in 1998. And if you're able to figure that out, then you have the cost basis for that beneficiary's asset, which is stock. Now, what about property that you received in exchange for services you rendered? This is also called barter. Generally, you must include the fair market value of property you received in exchange for services in your income. Your cost basis will then be the fair market value you included in your income in the year you acquired the property, plus or minus any adjustments. And here is the first password of the day. Because we do not have a quiz review or a homework review today, the first two passwords I'm giving you are not associated with tests. So they will not unlock answer keys, but you do need them for the password test. The first password of the day that is not associated with a test is Anglo-Arab, Angloarab. Moving on to the next topic, closing costs and other acquisition costs. If you purchased a home or other real estate, you will nearly always pay closing costs. Closing costs can include things like escrow, title, and recording fees, taxes charged on the purchase, loan assumption fees, points, discount points, or loan origination fees. Points are generally a percentage of the mortgaged amount and are considered to be a form of prepaid interest. So what is a point? Well, points are something that we pay all the time, but most people don't call them points. They call them loan discount fees or loan origination fees. And if you use the word point with your customer and say, did you pay any points when you bought your home? They're probably going to say no because they don't know what a point is. But if you ask them, did you pay a loan origination fee or a loan discount fee, you might get a yes. You're more likely to get, I don't think so, or I'm not sure, because the reality is they don't really know. So when you're dealing with points, it's really important to ask for those closing papers. And of course, in our itemized deduction session in part 1 of the basic tax course, we did show you how to look at closing papers to find those points. So if you purchased a home other than real estate, you will nearly always pay closing costs, and closing costs can include points. They can also include other settlement charges you may have paid to acquire the property. Costs you might incur upon the purchase of property other than real property include things like sales taxes, loan fees, title fees, and registration fees. These are common with cars, but they can be paid on other assets too, like, say, a motor home or a boat. And then there are delivery and installation charges. So let's just suppose, well, you buy a refrigerator and you get it delivered and you get it installed. Well, the cost of the delivery and the installation of that asset adds to its cost. Now, if you purchase that asset for your house, odds are you're never going to have to worry about selling it or reporting a gain or a loss on it. But if you purchase a refrigerator for use in your business, the cost of delivery and installation is going to be very relevant. You're going to want to know what those are because they add to your cost in that asset. Note that the rules regarding the treatment of closing costs vary depending on whether the loan is for personal use property or business use property. Now we're going to learn about something called the adjusted basis in property, and you've probably seen this term used earlier in the course, but today we're going to get kind of more of a grounding in what it means. The adjusted basis is the cost basis of your property plus or minus any of the following, and it could be plus and minus, frankly. Firstly, amounts you invested into your property to improve its value, add to its value, or extend its useful life. Amounts you claimed as a tax credit or tax deduction upon acquisition of the property. Postponed gains from the sale of your home. Postponed gains from a like-kind exchange. The amount you claimed or presumed to have claimed for depreciation on property you used for business. Any other amounts you received in relation to the property that have not been previously reported in your income also affect the adjusted basis. So let's look at some examples of adjustments to basis. Beginning on this side, we have increases to basis, and on this side, we have decreases to basis. So let's look at things that increase your basis in property. Well, your basis in property is increased by things like capital improvements. And capital improvements include putting an addition on your home, replacing an entire roof, paving your driveway, installing central air conditioning, and rewiring your home. Assessments for local improvements also increase basis, and they include water connections, sewer hookups, sidewalks, and roads. Casualty losses, the cost of restoring the damaged property to its original condition, increases your basis. Legal fees, the cost of defending and perfecting title, increases basis, as well as fees for getting a reduction of an assessment. Zoning costs can increase your basis. Taxes and interest you pay on unimproved real estate if you make the election to capitalize these costs. So normally, when you own land, you are allowed to claim a tax deduction as you go for the real estate taxes you pay on that vacant land. Mortgage interest, however, on that land is not deductible because the land, if it is vacant, cannot be your home. Typically, the smart thing to do with a vacant land is to make an election to capitalize the carrying costs, including property taxes and interest. And if you do that, then any property taxes or interest you pay during the time you hold that land adds to your cost. Finally, real estate taxes and mortgage interest paid on behalf of the seller increase cost. If you are the buyer of property and you pay taxes or mortgage interest owed by the seller, for the seller, those amounts that you pay for the seller add to your cost in the property, but you yourself are not allowed to claim a deduction for those costs because they were not debts that were owed by you. Now let's look at things that decrease basis, beginning with the Section 179 deduction. Well, the Section 179 deduction is something we're going to learn about in depreciation. And if you claim a Section 179 deduction, it reduces your basis. Also, if you claim a deduction for clean fuel vehicles and refueling property, that decreases basis. Non-taxable corporate distributions are a return of cost and therefore reduce basis. Deductions previously allowed or allowable for amortization, depreciation, and depletion, all of those things reduce your cost. Exclusion for subsidies for energy conservation measures. Credit for qualified electric vehicles. Postponed gain from the sale of a home. Investment credit, part or all that was taken. Casualty and theft losses and insurance reimbursements reduce costs. Certain canceled debt excluded from income. Rebates from a manufacturer or seller. Easements. Tax credit or refund for buying a diesel-powered highway vehicle all reduce cost and are decreases to your basis in property. Amounts you spend to improve or extend the useful life of your property. What does that mean? Because these increase your basis. While an amount a person or business spends to improve or extend the useful life of property is one of the more confusing topics to many taxpayers. Many people expect, and it's quite logical that they expect, they should be able to claim an instant deduction when they spend money on their property. And while the law does allow for certain instances when a current year deduction or credit can be taken, for example, a credit for energy efficiency improvements to your home is a credit that you're allowed to claim, right? And in the year you make those improvements, you get to save money on your tax return. But that's rare. It is more often the case that a deduction will not be allowed. If you use property for personal purposes, your home or car for instance, you generally cannot claim a deduction for the acquisition cost of the asset or for costs you incur to improve or maintain the asset. Let's look at an example of how we determine the cost basis in a piece of property and how various costs associated with the acquisition of the property can add to the basis. You purchased your home for $200,000 and closing costs you paid when you acquired the home included the following. There's the purchase price, $200,000. But when you purchased the property, you also paid title and recording fees, title insurance, and other closing costs. And all of those items add to your cost basis in the property. They pull your cost in the property up to $203,100. But there's other costs that are deductible on Schedule A, such as the loan origination fee and prorated property taxes that may also have been paid at close. And those costs are deductible on Schedule A and therefore cannot add to your cost. So to calculate your basis in the home, you subtract deductible closing costs from your acquisition cost. And once you've done that, you have your cost basis. So all of these items add up to $206,000, but we have to subtract out the amount that can be deducted on Schedule A, and that's what leaves us with our adjusted basis in that house. So you can claim points and property taxes as an itemized deduction on Schedule A, and therefore the acquisition cost basis of your home includes the purchase price, title and recording fees, title insurance, and other closing costs, which in this illustration total $203,100. Now, any future amounts you spend to improve or extend the life of your home add to its adjusted basis and are generally referred to as home improvements. Home improvements include amounts that you spend on room additions and adding a second story, installing a new driveway, roof, fence, deck, or patio, remodeling one room or your entire house, rewiring, replumbing, recarpeting, residing, or other similar improvements, adding or replacing fixtures such as appliances, lighting, doors, etc., and city or county assessments for roads, sidewalks, sewers, etc. Well, what is a city or a county assessment? Well, essentially what will happen is, let's just suppose you live in a neighborhood where the streets are not paved, or you live on a street that is paved but there's no sidewalks. And the city comes along and says, we're going to do improvements, and because we're doing improvements, we're going to assign a cost to these improvements to you, and your share of the cost of these improvements is, say, $5,000. And they may even include the cost of those improvements in your property tax assessment, where you have to be paying those off over time as a part of your property tax assessment. The interesting thing about them is they are not a tax, and therefore they are not deductible on Schedule A. But they do improve The neighborhood, they improve the value of your house because having a sidewalk on either side of the street can improve the value of a neighborhood. And obviously having a paved road over a gravel road also improves the value of your home and the neighborhood that your home is in. So these items add to the cost basis of your home because they are improvements that improve the value of your home. And if the city comes along and makes an assessment against your property and you are liable for paying that assessment, then the amount that you're liable for paying and need to pay does add to your cost basis. Now, expenses that do not increase basis include repairs such as fixing a broken lock or a hole in a leaky roof, maintenance costs such as mowing and maintaining your garden, cleaning your carpets, spraying for carpenter ants, cleaning your chimney, etc., the cost of refinancing your home, and insurance premiums. All of these are necessary costs of ownership of a home, but none of them add to the basis of the home. They are generally maintenance issues. Tax deductions and credits you claim upon the acquisition of property. If you claim a deduction or credit because you acquired property given special treatment under the law, you must subtract the amount deducted from your home or credited against your tax from your cost basis. Here are some examples of the types of deductions that you might be able to claim when you purchase property, such as points on a loan to purchase or improve your main home. Well, we already know how to deduct those on Schedule A. And the Section 179 deduction for property you placed in service for your business. We haven't learned about that yet, but it's coming. And depreciation or amortization deductions on property you use for your business. Examples of the types of credits you might be able to claim include the credit for hybrid or electric vehicles, business credits allowed for the purchase or development of property, including purchase and or installation of energy-efficient devices, advanced energy projects, rehabilitation projects, and disabled access expenditures paid by a small business to comply with the Americans with Disabilities Act. Depreciation and amortization. If you previously claimed or should have claimed depreciation on your business asset, you must subtract any depreciation claimed or claimable from your basis in your property. Allowable depreciation reduces your basis in property you own, even if you do not actually go ahead and claim the deduction. So in other words, depreciation is actually mandatory, and depreciation is coming up in our very next class. Postponed gains from the sale of your home. Well, if you've been around long enough, you might remember the old days, and those are the pre-May 7, 1997 days. So it's been about 12 years since we've had to deal with these rules, but 12 years actually isn't that long. So we're actually 13, we're at the 14-year point, 2011. We're at the 14-year point since we had to deal with these issues. But it's not hard these days to run across someone who's owned their house for more than 14 years. So let's just suppose you have a tax client who purchased their house in 1997, in January of 1997. And when they bought it, they had previously owned another home. And they sold that other home at a gain. Let's just say they sold it for a profit of $50,000. Well, back in those pre-May 7, 1997 days, if you sold your home for a profit, you had 2 years to purchase a new home of equal or greater value and move into it. And if you did that, then you could postpone realizing the gain or postpone paying taxes on the gain. So it is possible, even though this was quite a while ago now, that there are still people out there who have a cost basis in their home that is less than what they paid for it. So let's look at an example here. Let's suppose you have a house that you paid $100,000 for in the year 1990. And in 1996, you sold it for $150,000 so that you had a $50,000 gain. Well, under the rules that had existed in those days, you had 2 years to purchase a replacement home that cost $150,000 or more. So let's just suppose that in that same year, you purchased a new home costing $200,000. Well, interestingly, your cost basis in the new $200,000 home is only going to be $150,000 because you're going to take your original basis in your original home and you're going to add in the additional money you had to pay for the new home, which was only $50,000 more than you sold the old home for. So your cost basis in the new home would be $200,000 minus the deferred gain of $50,000 to give you a cost basis of $150,000 in the new home. And we do cover sale of home in greater detail in session 16 of this course. Next, we have postponed gains from a like-kind exchange of business or investment property. And in a way, a like-kind exchange deferral of gain is very similar to the postponed gain on sale of your home. The rules for each are different, but the concept is the same. If you previously elected to postpone the gain on the disposition of your property because you traded for a property that is like kind, you must subtract any postponed gain from the basis in the new property. And we also cover like kind exchanges in session 16 of this course. Important rules relating to the basis of real estate. Real estate taxes that are paid for the seller by the buyer. If a buyer pays real estate taxes that are owed by the seller of a property as a part of the purchase cost of the property, then the buyer will add the taxes paid for the seller to his or her basis in the property, and the seller will be able to deduct the taxes on his or her Schedule A. Or if he was selling, for example, a rental property, then he would deduct them on Schedule E. Now, if you paid taxes owed by the seller, you cannot deduct them as taxes paid on your Schedule A, C, or E. This is because you cannot claim a deduction for taxes that are for a period of time when you did not own the property. Instead, you add the taxes you paid for the seller to your basis in the property. Now, what happens if the real estate taxes are paid by the seller for the buyer? If a seller of property pays property taxes for the buyer, then the seller will add the amount paid for taxes to his or her basis in the property, and the buyer will deduct the taxes as appropriate on Schedule A, C, or E. If you purchase property and the seller pays taxes for a period of time when you are the owner of the property, then you deduct these taxes as appropriate on Schedules A, C, or E. In addition, you must reduce your basis in the property by the amount of taxes that the seller paid for you. So that might be a little bit difficult to understand, therefore I have an example. Oksana purchased a home from Jackson. The sales price is $100,000 and Jackson agrees to pay $2,000 towards property taxes for the first year that Oksana will own the home. Jackson paid the taxes to the county treasurer at the close of the sale. Oksana must reduce her basis in her home to $98,000. She will deduct $2,000 for property taxes paid on Schedule A. Jackson will add the amount he paid in taxes for Oksana to his basis in the property. His amount realized from the sale will therefore be reduced by $2,000. The amount realized has to do with his profit from the sale. Settlement costs that add to the basis of property. You include in the basis of property you buy the settlement fees and closing costs for buying the property. A fee paid to buy property is a cost that must be paid even if you bought the property for cash. The following items are some of the settlement fees or closing costs you can include in the basis of your property. Charges for installing utility services, legal fees including title search and preparation of the sales contract and deed, recording fees, surveys, transfer taxes, owner's title insurance, and any amounts the seller owes that you agree to pay, such as back taxes or interest, recording or mortgage fees, charges for improvements or repairs, and sales commissions. Loan and other costs not added to the basis of property. Do not add any of the following costs to the basis of your property: costs and fees paid for getting a loan on the property, or amounts placed in escrow for the future payment of items such as taxes and insurance. So what are loan fees? Well, examples of loan fees include points, including discount points and loan origination fees, mortgage insurance premiums, loan assumption fees, the cost of a credit report, fees for an appraisal required by a lender, and fees for refinancing a mortgage. Examples of escrow items. The following items are examples of settlement fees and closing costs you cannot include in the basis of property. They include fire insurance premiums, rent paid to occupy a property before closing, and charges for utilities or other services related to occupying a property before closing. How to treat loan and escrow costs. If you paid loan or escrow costs relating to business property you own, you should capitalize or deduct these costs as follows. Loan fees are capitalized and amortized separately from the property purchased. For example, the purchase price and closing costs of a residential rental property are depreciated over 27.5 years. The loan fees paid to purchase the rental property are amortized over the life of the loan, which could be 20 years, it could be 30 years, it could be 10 years. Here's an illustration. A rental house is purchased at a cost of $120,000. $100,000 is allocated to the building and $20,000 to the land. Loan fees paid on the acquisition of the property totaled $3,000. The cost of the rental house should be entered on a separate line of the depreciation schedule than the loan fees as shown below. We have the asset description, which is the building, and the cost of the building was $120,000. The depreciable basis of the building is $100,000, and that's because you're not allowed to depreciate the cost of land. The life of the building is 27.5 years. The method of depreciation is makers, and the annual depreciation amount allowed is going to be $3,636. But the loan fees are separated out. They're put on a separate line, and different depreciation or amortization rules are applied. The loan fee cost is $3,000. The depreciable basis is $3,000. The life is 30 years. The method is amortization, and the depreciation allowed each year will be $100. And it's actually amortization, so the amortization allowed each year will be $100. Let's compare loan fees or loan costs with escrow items. Escrow items are deducted as operating expenses at the time payment is made from escrow. For example, let's just suppose you purchase a rental house, and at the time you purchase that rental house, money goes into escrow. You have to put money into an escrow account to pay property taxes and insurance. Well, the money is deductible on Schedule E when escrow sends it out to make those payments. So on the day that escrow makes payment for property taxes, now you're able to claim an expense for property taxes paid. And on the day escrow sends out the money to pay the fire insurance premiums, that's when you get to claim that as an expense on Schedule E. Now, what about the treatment of loan and escrow costs on personal use property? Loan fees and escrow costs relating to the purchase of your home do not add to your basis in the home. If you paid points on the purchase of your home or made escrow deposits to pay property taxes, these amounts are deductible on Schedule A in the year they are paid. The election to capitalize mortgage interest and property taxes on unimproved real property. If you own unimproved real property, that is vacant land, you can either deduct mortgage interest and property taxes you pay on the land as an investment expense, or you can elect to capitalize these costs. The following costs of owning unimproved land and unproductive real estate can be capitalized: annual taxes, mortgage interest, and other carrying charges such as legal fees or association fees paid in association with the land. You must file a statement with your original return for the year you wish to make the election to capitalize these costs. The statement must indicate the item or items that you wish to capitalize. Amounts you receive in relation to your property. If you have received financial or tax benefits in relation to your property that were not included in your income in a prior year, you must subtract these items from your basis. Examples of these benefits include rebates received from a manufacturer or seller upon the acquisition of property, forgiven or canceled debt on a loan that the asset is secured, insurance reimbursements you receive from a casualty, theft, or loss, and tax deductions you claimed for a casualty, theft, or loss. So you can see that there are a lot of things you have to keep track of in terms of tracking the basis of personal property and business property. And it can be quite a bit of work, and most people, quite frankly, aren't very good at it. It requires organization and maintaining records. And we have a very mobile society where people pack up and move all the time. And when you pack up and move, you think, what don't I need anymore? And you start throwing stuff out. Or maybe you're just not very good at organizing. You have it all, but you'll never find it because it's in big boxes in the basement, and you'll just never find it. But it is important, and here's why we need to track the basis of property. So, since the law does not allow you to claim a deduction for improvements or repairs you make to your personal property, and it's a lot of work to keep track of all of those improvements and repairs, why track it at all? Well, number one, you should keep accurate records of acquisition cost and the cost of improving your property for when you sell it. If you sell your home, car, or other property, you may have a capital gain or profit on the sale. The law requires you to report and pay taxes on profits you make from the sale of your property, including your business, investment, and personal property. You may convert your personal property to business use at some future date. Your cost basis for depreciating personal property you convert to business use is adjusted by amounts you spent to improve your property. Let's just suppose you purchased your home in 1990 for $40,000. And then in the year 2012, a long time later, 22 years later, you decide that you're going to convert that home to a rental home. Well, you remember what you paid for it way back then, but have you made any improvements to it over time? Because if you have, it could be that you've made $60,000 of improvements to your property so that the cost has increased. And if your cost has increased, then when you convert it to business use, you will be able to begin depreciating based on that higher cost. If you haven't kept track of the improvements, then you're going to be left with claiming depreciation on what you can prove. And conversely, let's just suppose you go and sell that home and you sell it for a good amount of money. How are you going to figure out how much your profit is if you didn't keep track of those costs over time? Let's move on now to a discussion of the basis of stock. You calculate your basis in stock in the same way you calculate your basis in other property. However, sale or disposition of stock is often subject to special treatment, so it is important to be aware of some of the rules affecting the sale of stock. The most confusing aspect for many people is determining the acquisition date and price of stock. How you acquired stock is the first step in solving the problem. Possible methods of acquiring stock include purchase, gift, inheritance, divorce, employee stock option plans, employee stock purchase plans, and employee stock awards and restricted stock units. Purchase of stock. If you purchase stock, you should keep accurate records of the dates and the number of shares of each kind of stock that you bought. Most investment companies keep computerized records of your transactions. However, if you switched investment companies, those computerized records would not typically move to the new company. You should keep all records of your stock purchases from the date you purchase the stock until 3 years after you sell the stock. Be especially sure to keep records of any stock splits or spin-offs that might occur while you hold the stock. Note, a new law mandating basis reporting for publicly traded securities takes effect for the year 2011. There will be an expanded Form 1099-B, proceeds from broker and barter exchange transactions, which will be introduced for calendar year 2011 sales, and it will be furnished to taxpayers in early 2012. This expanded form will include the cost or other basis for the securities that were sold to assist the taxpayer with figuring gains and losses to be reported on Schedule D. Well, figuring the cost basis in stock and tracking the cost basis in stock has just been a royal headache for the tax profession forever. And brokerage houses have the ability to track this information, but typically they've never been required to. And so although they may do it as a customer service benefit for their investors, it's just as likely as not that they have partial records, inaccurate records, or no records at all. And there is a new law coming into place that's going to be forcing these stockholding and brokerage houses to track basis for stockholders. But we're still going to be having this implementation phase where investors have to be delivering their cost basis information to the investment companies. So if you have an investor who has a cost basis of $1,000 in some shares he owns, and he's never given that information to the brokerage house, then the brokerage house is not going to be able to give accurate information on their cost basis. So even though this new 1099-B that will be coming out in 2012 for calendar year 2011 does have space on it to show cost basis, I predict it's still not going to be very accurate for a long time. Gifted stock. If you receive stock as a gift, you should ask the person who gave you the stock for their records of the original purchase. Your basis when you sell the stock will be calculated in the same fashion as other gifted assets. That is, your basis for calculating loss or gain on the sale of gifted stock will depend on whether the fair market value of the stock is less than, equal to, or greater than the donor's adjusted basis at the time of the gift. If the person or entity that gives you the stock does not have accurate records, try to get an accurate purchase date. You can consult periodicals and other reference sources to determine the fair market value of a particular type of stock issued if you have the following information: the purchase date, the number of shares purchased, the name of the company or mutual fund, the number of stock splits that have occurred since the stock was issued, and the number and valuations of any shares allocated to a new spin-off company. You can visit the website www.bigcharts.com for historical stock quotes, and you can also visit the shareholder relations site of the specific stock you own for historical stock information. I'm going to show you how to do all of that in just a minute. Next, inherited stock. If you inherit stock, your basis will depend on whether the decedent died before 2010 or after 2009. Your basis when you sell property will be calculated using the same rules shown on page 4 of today's session under Property You Inherited. The valuation date is chosen by the estate, and you must use whichever valuation method was elected by the estate. You can determine the fair market value of stock on a particular date if you have all of the information we just listed above under gifted stock. So let's go take a look at the internet and figure out how we can establish the basis in stock that a client might have if all we know is the number of shares they currently hold today and the date that they acquired them. So let's go figure this out. So I've done a search for bigcharts.com, and I come up with historical quotes for Big Charts. It takes me to the Big Charts website where I'm able to look up stock dates historically. So let's go to historical quotes and just type in some stock. And let's suppose that the stock I want to look up is Dell. I type in Dell and I look it up, and I've just selected a date. Well, this date was 9/23/06, which was a Sunday. Let's make it 9/25 and get to a Monday. And here we have it. We can see that Dell stock on 9/25/06 had a closing price of $26.95, an open of $26.81, a high of $27.19, a low of $26.79. Well, let's just suppose your mother purchased and gave you Dell stock as a birthday present, and your birthday was 9/25/06. And you never got any information from your mother about how much she paid for the stock, and then suddenly in 2009 she dies, and no one can find these records. You're not going to be able to go to the inherited value because it's not an inheritance. Instead, you're going to have to use the gift. And you're going to have to turn to the fair market value, or what she would have paid for that gift when she bought it. Well, if you know that she bought it on your birthday, you have something to work with. Now, of course, when you're dealing with audits, auditors want to see actual records proving a purchase. Well, the fact that you own the stock would be obviously a record and proof of ownership. It wouldn't be a record or proof of cost. However, if all you could do was come up with your birthday and that your mother bought it for you and gave it to you on your birthday, you might be able to convince the auditor of that. But this system I'm showing you is really foolproof when it comes to inheritances, because when we're dealing with inheritances, the law does say to go to the fair market value on the date of death. So if, by contrast, you've got Dell stock and you inherited that stock from your grandmother, and your grandmother died on 10/10/2002, and you know that date, you have that piece of information, you can go and look to see what that stock traded for on that day. And you would go with a high of 46, you would add that to the low of 43, divide those two numbers by 2, and you would get the average for the day, the average of the high-low for the day, and that would be your cost. But we do have to look at something here. It does show that the split adjusted price is $23.19. The adjustment factor is 2-to-1. That tells you that there was a split. So if you inherited stock from your grandma who died on October 10, 2002, your cost will not be what it was worth on the day she died, but rather half that cost, because after the split you had twice as many shares. Now let's just suppose that you have some Disney stock that you inherited and you want to look up the fair market value of Disney stock. Well, if I type Disney in Big Charts, probably not going to get anywhere. Symbol Disney not found. So what do? Well, you can go to the internet and look for the symbol for Disney, but another thing you could do is just look for shareholder services on Disney or Disney stock quotes. Let me just go Disney stock prices or stock values, and I'll do a search for that. And when I do that, my search engine pulls up this possibility: Walt Disney Company stock. Oh, and here we are, right there. I'm on a page where I can look up dates. So let's suppose I inherited Disney stock from my grandmother, and she died on 10/10/2002. So I'm going to go October 10, 2002 and look that up. And here we have it. On that day, there was a high of 1632, a low of 1571. We look at split adjustment factors. 1, it tells me that there were no splits. But if we go back in time and just say, let's make this 1998 or 1988, that might change things. Back in time further, I have a much different result. We have a split adjustment factor of 12. What that means is that the stock has split multiple times since then. And so the cost in that stock is $5.43 a share. That's accommodating or needs to accommodate a split adjustment factor of 12. So back to our manual. Stock acquired at divorce. If you acquire stock pursuant to divorce, your basis is the same as your former spouse's basis. You should use your former spouse's purchase date and purchase price to determine your basis. So what this means under stock acquired in divorce is there's no gain or loss on the transfer of stock between a husband and wife at the time they're married or in the process of getting divorced. So if as a part of a divorce you get stock that was purchased by your spouse, your cost in that stock is whatever your spouse paid for that stock. Or if that stock was gifted to your spouse, then you'd look to the gift rules that apply to your spouse at the time that gift was received. The next topic of the day is a really important one to understand. Employee stock options are one of the key reasons clientele come into a tax office for the help of a professional tax preparer. They're going to have received employee stock options at some time during the year. They've sold them, and now they don't know what to do, so they're coming to see you. So this can be a little bit overwhelming to learn, but the reality is it's just not that complicated. It just means you have to get some very important facts about cost basis. And once you tie it all together mentally and the light bulb comes on, it's the simplest thing in the world. But having said that, I can tell you that working with and supervising tax preparers for the past 18 years, it takes a long time for the light bulb to come on for most people. I'll do the best job I can, and hopefully the light will come on for you sooner rather than later. Employee stock options. There are 3 kinds of stock options: incentive stock options, employee stock purchase plans or ESPP options, and non-statutory or non-qualified stock options. These are also referred to as NQOs. So what is a statutory stock option? Well, there are 2 kinds of statutory stock options. They are incentive stock options, or ISOs, and options granted under an employee stock purchase plan, called an ESPP. Statutory stock options are relatively uncommon when compared to non-statutory or non-qualified stock options. However, employees who purchase and sell statutory stock options may get special tax treatment. To qualify for special tax treatment under the rules for statutory stock option plans, both of the following must be true. You must be an employee of the company or a related company granting the option from the date the option is granted until 3 months before you actually exercise the option. And 2, the option must be non-transferable except at death. So what is an incentive stock option? If you received a statutory stock option, you do not include the value of the option in your income when the option is granted or when you exercise it. Generally, you will report any gain from the sale of ISO stock on Schedule D. Your basis in ISO stock is the amount you paid for the stock when you exercised your option to buy. Your holding period for ISO stock begins on the day you exercise your option and acquire the stock. You must recognize or report the gain or loss on your tax return for the year in which you sell or otherwise dispose of stock. Keep this form and use it to figure your gain or loss. For more information, you should refer to Publication 525 on taxable and non-taxable income. Required holding periods. To receive special tax treatment for your incentive stock option or your employee stock option under the qualified treatment rules, to receive special tax treatment for your statutory stock options or your employee stock purchase plan shares, you must hold your statutory stock options for the following periods of time: at least 1 year from the exercise date and at least 2 years from the grant date. If you do not meet the holding period requirements for incentive stock options, you may have ordinary income that is reportable as wages for the year that you sell or dispose of the stock. If you do not meet the holding period requirements and you sell your stock at a gain, the difference between the option price and the fair market value of the stock is included in your income as taxable wages. The transaction would usually be reported in the same manner as non-statutory or non-qualified stock options and disqualified ESPPs, which is discussed later. So here is an example of a qualifying incentive stock option sale. Your employer granted you an incentive stock option on July 13, 2008 to buy 100 shares of Mega Corporation stock at $20 a share, when the fair market value of Mega Corporation stock is $30 a share. Then on August 23, 2010, you sold the stock for $35 a share. Because you held the stock for more than 1 year and you sold the stock at least 2 years after receiving the stock option grant, you must report your gain as a capital gain, and you calculate your capital gain as follows. You take the selling price, which is $35 times 100 shares, and that gives you a selling price of $3,500. You then look at your purchase price. Well, your purchase price was $20 a share, multiplied out by 100 shares. That gives you a cost of $2,000, giving you a gain or profit on the sale of $1,500. Does any of that have to get included as ordinary wage income? The answer is no, because you met the ownership and holding periods. Is any of the amount reportable as capital gain? Yes, all of it is. It's taxed as capital gains, and the amount reportable as capital gain is $1,500. Capital gain treatment is important because under capital gain rules, you pay less tax than you do under ordinary income tax rules. Now here is an example of a disqualifying ISO sale. Your employer granted you an incentive stock option on July 13, 2008 to buy 100 shares of Mega Corporation stock at $20 a share. You exercised or purchased the stock on January 10, 2009 for $20 a share, when the fair market value of the stock was $30 a share. Then on April 23, 2010, you sold the stock for $35 a share. Now, even though you held the stock for more than a year, you sold the stock within 2 years of receiving the stock option grant. You must report the difference between the option price of $20 and the fair market value on the date of the exercise, which was $30, as wage income. Then the rest of your gain is a capital gain, and it's calculated as follows. You'll have a sales price of $3,500, and your purchase price is still the same, $20 a share times 100 shares, $2,000. So you still have that $1,500 gain, but how that gain gets taxed is very different. And the reason for that is that you don't meet the conditions for having a qualifying sale. You have a disqualifying sale. And under the disqualifying sale, that spread, the difference between what it was worth on the day you exercised or bought and what you had to pay for it, is treated as wage income or compensation for services that you rendered to your employer. And so the amount that gets reported as wage income would end up on line 7 of your tax return rather than on line 13 as a capital gain. So the amount to be reported as a capital gain, well, you would take the amount that was reported as wages, which would be 30 times 100 shares, minus the 200 that you paid for those shares, and that gives you $1,000. So on the date that you bought, the shares were worth $3,000, but you only had to pay $2,000 to get them, and that $1,000 spread gets added to your W-2 as wage income. If you sell more than a year later and you sell for $3,500, well, your cost will be $3,000. If the sales price is $3,500, that gives you a gain, a capital gain of $500. Now, stock options, qualified stock options, were a very popular benefit given to employees in the 90s. But they've dropped out of favor, and the reason for that is that if you exercise a statutory stock option and you don't sell it, in the year of exercise you may be subjected to the alternative minimum tax. So that's one negative to the incentive stock options that are qualified incentive stock options. Another negative to qualified incentive stock options is, let's just suppose you do purchase that stock and then you do hold it for a full year before you sell it. So let's just suppose you have a grant date, you wait more than a year after the grant date, you buy, and then you wait a day more than a year till when you sell it, meeting those rules for statutory stock options. Well, the problem is, during that year of ownership, the stock could drop in value, so it's rather risky to the employee. So in the 90s, qualified stock options were pretty popular, but they were causing problems especially for the employees who were purchasing these shares because they were getting hit with alternative minimum tax. And then the stocks were dropping in value. They were paying tax on money they had never received. And then their stock was dropping in value, and they basically had nowhere to go with these losses. Then we move into the 2000s. And in the first decade of this 21st century, there was a big push with employers and employees for disqualifying incentive stock options. And those were very, very popular throughout the first decade of this century. But now we're seeing that there's movement again to something else different, and that is the employee stock option. And employee stock options are becoming the most common thing that I see. And let's talk about these. Employees who are eligible for and exercise stock option rights or participate in employee stock purchase plans are usually very confused and do not know how to report income from the sale of their stock or how to calculate their cost basis in options that they exercise. How you calculate basis depends on the kind of employee you are and the type of plan your company has. You should also research this information before you begin to calculate your basis. Because so many tax returns are filed with basis reporting errors for ESPP shares, the IRS has produced Form 3922 beginning with tax year 2010. The intention of Form 3922 is to provide employees with a record of their basis in the ESPP shares that they have purchased. And this is the form right here. It shows that the date the option was granted, the date that the option was exercised, and the fair market value per share on the grant date. Well, theoretically, the difference between the fair market value and the option price is going to be includable in that employee's wage as wage income. And therefore, the cost in the property is going to be the fair market value on the date of the exercise. So that's typically what's going on. Well, how do you arrive at that information looking at this form? Well, you don't. You simply have to understand what's going on. If you participated in an employee stock purchase plan, you do not include any amount in your gross income when you receive a grant or exercise an option to purchase stock. When you sell the stock you purchased by exercising an option, you may have to report wage compensation and capital gain or capital loss. Your holding period for ESPP stock begins on the day after you exercise the option. For additional information on tax treatment and holding period requirements, you should refer to IRS Publication 525, Taxable and Non-Taxable Income. Reporting the sale of ESPPs. If the special holding period requirements described below are met, the sale of stock is treated generally as a capital gain or loss. However, you may have compensation or wage income if the option price of the stock was below the stock's fair market value at the time the option was granted, or you did not meet both of the holding period requirements. So there are some holding period requirements for ESPPs, and they work like this. To meet the holding period requirement for qualifying ESPPs, you must hold the stock for 2 years from the time the option is granted to you and more than 1 year from when the stock was transferred to you. If you do not meet both of these holding period requirements, there is a disqualifying disposition of the stock. If the holding period requirements are not met, then your employer should report compensation, that is wage income, in Box 1 of your Form W-2 in the year of the disqualifying disposition. The amount to be reported as compensation income is the excess of the fair market value of the stock on the date the stock was transferred to you over the amount that you had to pay for the shares. Well, the whole good deal about employee stock purchase plans is that the employees are usually given the right to purchase at a discount. So if the stock is trading on the market for $10 a share, the employee might be able to buy it for $8.50 a share. So that's a discount, and that discount is called a spread. The spread between the employee price and the fair market value price is wage income to that employee. If the holding period requirements are met and the option exercise price is below the fair market value of the stock at the time the option was granted, you still generally report the discount as compensation wage income when you sell the stock. Generally, this compensation income is the lesser of the excess of the fair market value of the stock on the date of the disposition over the exercise price, or the excess of the fair market value of the stock at the time the option was granted over the exercise price. Now, I know that these rules don't mean much till you see them applied, so we're going to do a number of illustrations coming up pretty quickly. If the holding period requirements are met and your gain is more than the amount you reported as wage income, the remaining gain is a capital gain reported on Form 1040 Schedule D. If you sell the stock for less than the amount you paid, you have a capital loss and you do not have ordinary income. So how do you go about calculating your basis in an ESPP? For an ESPP option granted at a discount, your basis is the amount you paid plus any amount you included in your income as wages. Here is an example of a qualifying ESPP sale. Your employer granted you an option under its ESPP on April 19 of 2008 to buy 100 shares of Mega Corporation stock at $20 a share. Mega Corporation stock was worth $22 a share when this option was granted. You exercised or purchased the stock on October 10, 2009 for $20 a share, when the fair market value of Mega Corporation stock is $23 a share. Then on December 23, 2010, you sold the stock for $30 a share. Because you held the stock for more than 1 year and you sold the stock at least 2 years after receiving the ESPP stock option grant, you have a qualifying sale. You must report the difference between the option price of $20 and the fair market value at grant date, $22, as wages. The rest of your gain is a capital gain calculated as follows. The selling price is $30 times 100 shares, or $3,000. The purchase price is $20 times 100 shares, or $2,000, giving you a gain of $100. But on the date that you exercised, you already had a built-in gain of $200. That was the spread between what it was worth and what you had to pay for it. And that $200 needed to be reported in your income as wages at that time. Then you have the amount that you get to report as a gain. Well, your gain is going to be the sales price minus your cost, but your cost is going to include what you paid for it as well as the additional amount that was put into your income as wages. And so ultimately you have a capital gain of $800. Now in this illustration, your wage compensation is the lesser of the spread between the grant price and the exercise price, or the grant price and the fair market value. And in this instance, the lesser amount is $200. Let's contrast this with a second illustration of a disqualifying ESPP sale. Your employer granted you an option under its ESPP on April 19, 2008 to buy 100 shares of Mega Corporation stock at $20 a share. Mega Corporation stock was worth $22 a share when this option was granted. You exercised or purchased the stock on April 10, 2009 for $20 a share when the fair market value of the stock is $23 a share. Then on April 23, 2010, you sold that stock for $30 a share. Now, even though you did not sell the stock within 2 years of receiving the ESPP stock option grant, you sold the stock within 1 year of its transfer to you. You must report the difference between the option price of $20 and the fair market value on the date of purchase, $23, as wage income. And then the rest of your gain is a capital gain calculated as follows. So we still have the same sales price, we still have the same purchase price, and we still have the same gain. But the difference is how that gain will get taxed. And because we do not meet the holding period requirements, we do not get the special capital gain treatment for the spread that had to do with appreciation after that stock option was granted. So it was granted at 23. It was exercised for 22, but on the date of the exercise, it was actually worth 23. And so we're going to have to go with a full $23 value amount being grossed up in the W-2. And so the W-2 should show $300 additional wage income. That wage income adds to the cost in the stock, meaning that the cost in the stock goes from $2,000 up to $2,300. If we sell for $3,000, that would give us a $700 capital gain. So since this is a disqualifying disposition, you must report as wage income the spread between the grant price and the purchase price, plus any increase in fair market value on the purchase date, which was $100. The W-2 income would therefore total $300, and that $300 would add to the $2,000 purchase price to give a cost of $2,300. Compensation income relating to the exercise of NQOs and ESPPs. This is what confuses tax preparers and tax clients alike, and the reason tax clients come into a tax preparer is to help unravel this mysterious universe of stock options and how you figure cost in them for an employee. Well, a key fact to remember when calculating an employee's basis in stock acquired through the exercise of non-qualified stock options or an employee stock purchase plan is that any discount is generally considered taxable income to the employee and must be reported as wage income in Box 1 of the employee's W-2s. So I've shown you in today's class an illustration of a qualifying incentive stock option and a disqualifying incentive stock option, or an NQO. I've shown you a qualifying ESPP and a disqualifying ESPP. Well, the reality is that nearly every employee has disqualifying transactions. And so for virtually everyone out there, these very simple, straightforward rules apply. But if you establish that you have an employee who did meet the holding period requirements, then you have to look at whether or not they've got a qualifying transaction. And if they do, then things work slightly differently. So let's look at compensation rules relating to ESPPs. And really these come from IRS Publication 15B, which is an employer's handbook to fringe benefits. And fringe benefits are essentially benefits that are taxable to the employee as wage income. And the rule is that an employer can pay a wage to an employee, and of course that's very clear. You pay the wage, it has to be payroll tax, withholdings, and so forth. But if the employer gives the employee something other than a wage, what do? Well, the IRS says that's typically a fringe benefit, and it's going to be taxable as if it was a wage. That means it has to go into Box 1. And whether you give free airplane tickets or whether you give stock, the rule is the same. So IRS says that an employer must include as income in Box 1 of the Form W-2 the discount that is given to an employee on stock acquired by the employee through an employee stock purchase plan when that stock is sold or disposed of, and the spread or difference between the exercise price and the fair market value of the stock at the time of the exercise given in a disqualifying sale or disposition of stock acquired by an employee through the exercise of an incentive stock option or an employee stock purchase plan. So if you have a qualifying transaction, number 1 applies. If you have a disqualifying transaction, number 1 and number 2 both apply. So let's take a look back at that mega corporation ESPP illustration. In example 1, the discount that was given to the employee is $200, and therefore $200 must be included in the employee's W-2 as wage income. And in an example number 2, the spread or difference between the exercise price and the fair market value of the stock on the date of exercise is $300. So $300 must be included in the employee's W-2 as wage income. Now let's look at the compensation rules relating to NQOs. NQOs have to do with incentive stock options. These are different than employee stock purchase plans. An employer must report the excess of the fair market value of stock received upon exercise of a non-statutory stock option over the amount paid for the stock option on Form W-2 in Boxes 1, 3, and 5, and in Box 12 using Code V. Non-qualified stock options and disqualified ESPPs. Because many employees sell their stock as soon as they are purchased, the most common types of transactions seen are the sale of non-qualified options, or NQOs, and disqualifying sales of ESPP shares. The calculation of basis is the same for both of these types of transactions. However, they are reflected differently on the W-2. As an employee of a company, your net income from the sale of shares acquired from NQOs and ESPPs is generally treated as wages. If your NQO plan allows you to purchase stock at less than its fair market value, the difference between the fair market value of the stock on the day you purchase it from your company and what you actually pay for it must be included in your income as wages. The amount included as wages is included in Boxes 1, 3, and 5 and is identified in Box 12 with a Code V. If you sell your ESPP shares before the holding period is over, then the difference between the fair market value of the stock on the day you purchase it from your company and what you actually sell it for must be included in your income as wages. The amount is only included in Box 1 and is often not identified on the W-2. Payroll taxes. Wages for Social Security, Medicare, and federal unemployment taxes do not include remuneration resulting from the exercise of an incentive stock option under an employee stock purchase plan, or from any disposition of stock acquired by exercising such an option. So what this is saying is that for ESPPs, there's no Social Security or Medicare tax due on that spread or benefit that the employee is receiving. But with incentive stock options, the difference between the fair market value of that stock and what the employee pays for it is included as wage income and is also subject to Social Security and Medicare tax. But with ESPPs, you are not subject to Social Security and Medicare tax on that difference. You're only going to have to report that difference as wage income. So here is a comprehensive illustration of how you could have an employee in the same year exercise NQOs and ESPPs, how these two different types of stock benefit will be treated under tax law for that employee. So here is part one of the illustration. Tech employee is an employee of tech company. On February 19, he bought and sold 199 shares through his ESPP at $21.263 per share for a total cost in the 199 shares of $42.3134. The fair market value of the shares on February 19 was actually $30.475 per share, or $6,064.53. Then on August 19, he bought and sold 82 shares through his ESPP at $18.705 per share, or $1,533.81. The fair market value of the shares on August 19 was actually $22.005 per share, or $1,804.41. Well, you calculate tech employee's basis in his ESPP shares as follows. You look at the number of shares and the amount that he paid for the shares, and then you look at the fair market value of those shares on the date he bought them. You subtract the amount he paid from the fair market value, and you get the difference, which is $1,833.19 profit to that employee on the first purchase, and a $270.60 difference for that employee on the second purchase on June 7th. Well, tech company is required under the law to treat this difference or spread as wage income in Box 1 of tech employees W-2. So what that means is that the company is going to gross up the employee's wages by $2,103.79. Now, if tech company did not do this, that is, did not include these amounts in his W-2 income, then he must add them to his wage income on line 7 of the Form 1040. But most companies pretty much have their act together in this regard, and they have done the gross up. But as a tax preparer, we cannot assume that the gross up has happened. We have to go look for it. Or let's look at how we then figure tech's cost basis in the ESPP shares that he now owns. There was the number of shares he bought, there was the amount that he paid for the shares, and there was the amount that tech company reported as income to him. When we add all of that up, we get a total ESPP cost basis to tech employee of $6,064.53 for the first 199 shares and $1,804.41 for the second 82 shares. So his cost is going to be what he paid plus the amount that was included in his income as wages. So ultimately, his cost is the fair market value on the date of the exercise. Now, on March 3, Tech also exercised an option to buy and sell 199 ISO shares as follows. 359 shares at $20.23 per share and 640 shares at $19 per share. So the total cost of the 999 shares is $19,422.57. The fair market value of those shares on March 3 was actually $30 per share, or $29,970. Then, on June 7, Tech exercised an option to buy and sell 1,275 ISO shares as follows. 262 shares at $18.63 a share and 1,013 shares at $20.7423 per share. So the total cost of 1,275 shares to Tech employee is $25,893.01. But the fair market value of those shares on June 7th was actually $28.50 per share, or $36,337.50. Since both of these option ISO shares are non-qualifying dispositions, or NQOs, you calculate Tech's basis as follows. You look at the number of shares and the amount paid for those shares. You also look at the fair market value of the shares on the purchase date. You subtract the amount paid from the fair market value on the purchase date, and you get a difference or spread for each of those transactions. $10,547 for the March 3 transaction and $10,444 for the June 7 transaction. Tech company, under the law, is required to report those combined amounts which are $20,991.92 as wage income in boxes 1, 3, and 5 of Tech's W-2, and then identify the amount in box 12 with the code V. So Tech's cost basis in the ISO stock is calculated as follows. There's the number of shares he bought, the amount that he paid for the shares, the amount that Tech Company had to report as income on his W-2, and that means that his total cost basis is essentially the same as the fair market value on the date that he exercises. So how are these items going to look on the W-2 of Tech employee? Well, the total amount included as wage income for mega corporation ESPP and ISO shares is calculated as follows. We look at the method or type of option, and we have two different exercises of ESPPs. We have the number of shares bought and the amount reported as wage income for each of those transactions. We then have the ISO transaction, and there were two ISO transactions, 999 shares, 1,275 shares, and the amount of wage income reported for each of those transactions. So we look at the total amount of wage income for all four of those transactions, and we get $23,095.71. Because only two of the four transactions are ISOs, that is incentive stock option plans, those are the amounts that will also get reported in box 12 with a code V next to them. So we should be seeing a code V in box 12 for $20,991.92. Now the thing is that on this total here of 23095.71, box 1 is going to include this number, but there's nowhere on the W-2 that it has this number printed by itself. But we're going to be looking for evidence to support our assumption that $23,095.71 has been added to Tech employees' W-2. You should note that the $2,103.79 of wage income that is realized from the mega corporation ESPP shares, that is the sum of these two numbers, 1833 plus 270, that gives us 2103, is not subject to Social Security and Medicare tax withholdings and also is not reportable in box 12. So it should be somewhere in the W-2, but it might be a little bit hard to figure out if it is. So let's take a look at the W-2 for Tech employee and let's see if we can decipher any of this information. Firstly, we have box 1 where we report wage income. Well, where does the number in box 1 come from? Well, it's going to come from a combination of things. It's going to come from the incentive stock options. It's going to come from the ESPPs. It's also going to come from regular wages and overtime and bonus pay. There's a total number in that box, and that number also does not reflect income that was earned that is either tax exempt or tax deferred. For example, we have a 401k contribution showing right here in box 12, code D, $7,797 if wage income was earned but is not reflected in box 1 because it was deferred to a 401k plan. So it can be quite a mystery to figure out this W-2 and what's going on with it. So I've gone ahead and described it for you. So let's look first at this code V, because the code V does show the $20,992 that I told you should be there. The difference between the option price and the fair market value is included in income as wages paid. So box 12 code V reports the amount of income from the exercise of the options that was included in wages. And we had those two separate option transactions, and therefore we have that code V amount showing the correct number. Over on the other side of things, we do have that 401k contribution that was made by an employee is excludable from box 1 wage income, but is still includable as wages for Social Security and Medicare taxes. If we take box 3 and subtract out box 12, code D, we should get the number that appears in box 1, but that's not true. And the reason it's not true is that these ESPPs are not subject to Social Security tax. So essentially what we could know, rather, is that if we take box 1 and add the amount shown with the code D, that's going to be the true total wages paid for the year. So let's take a look at how this works. The amount shown in box 1 wage income for a Tech employee is the regular wages that were paid plus the employee stock purchase plan plus the ISO amount minus the 401k contribution. How do we verify that the ESPP discount of $2,103.79 was actually added to box 1 and is in there? Well, we just do some simple logic. We take the box 3 wages and we subtract out the 401k contribution amount of $7,797. When we do that, we get $68,324. We then add in the amount of the ESPP profit that was included in wage income. That was $2,103.79. When we take these two numbers, 68 plus 21, we get $70,428, and guess what? That's the number that it's up here. Now, there's other ways you can backdoor your way into that calculation, and me explaining it to you will not help you get it. I think this is one of those things where if you turn the video or pause video right now and just sit here and reread this section, the light might come on after you've spent 5 or 10 minutes really thinking about it. Please note that most employees exercise and sell their options in cashless transactions. This makes it even more confusing to the employee because in a cashless transaction, the stock is exercised and sold without the employee ever paying for the stock, seemingly. The net income from the sale of the stock is added to the employee's wages and is reported on their W-2. Social Security, Medicare tax, when it's applicable, and withholding taxes are deducted from the proceeds. Now, beginning in 2003, employees who exercise and sell their stock options in a cashless transaction do not have to report the sale of options on Schedule D when the employers properly report the income on Form W-2. However, if an employee receives a 1099-B for the sale of the option, then the Schedule D must still be filed. And in virtually every case, a 1099-B is issued. So if your client tells you that they didn't get a 1099-B, you'd better disbelieve them because usually there is one. Now, if they're right and there was none, you might have them run around to prove nothing. But more often it is the case that I have a client tell me, oh, there was no 1099-B, my employer told me it wouldn't get reported on a 1099-B, and then it does get reported on a 1099-B, and that client gets a letter from IRS saying they owe a bunch of tax on money they never made. So for safety's sake, it's usually a good idea to report these on Schedule D, even when you can't find the 1099-B. Now let's continue on with Part 2 of this illustration because I've just finished telling you that a 1099-B is usually issued. Well, let's see what happens when a 1099-B is issued. So in Part 2 of our illustration, tech employee receives a 1099-B reporting a sale of ISO and ESPP shares and therefore must complete Schedule D as follows. So a 1099-B reports to the IRS how much money stock sold for. And we can see all of these shares lining up ever so nicely. And that's one of the things that I do when I'm matching employee stock purchases and incentive stock option purchases with sales. I'm looking for similarities in numbers. But there's no rule that says you have to purchase 100 and sell 100. You could purchase 100, purchase another 100, and then sell 200. But ultimately, you need to be looking to match up the number of shares purchased with the number of shares sold. When we look at these, we see the net proceeds. Well, these net proceeds are not necessarily the fair market value. They could be slightly higher or slightly lower than the fair market value because if you exercise a stock option or purchase stock under an employee stock purchase plan, even if it is a very brief period of time, there is still a period of time where you are holding that stock. It might be a few minutes or a few hours before that stock is actually sold. And during that holding period, there can be fluctuations in the market that could cause you to realize a profit when it's sold or to cause you to realize a loss when it's sold. Even if there's no fluctuation in the market at all, there's usually transaction fees that you have to pay. And if you have to pay a $10 transaction fee to sell that stock, then that transaction fee is going to add to your cost and kick you into a loss. So usually what I see is with these NQOs and these ESPPs, that when you consider the fact that the spread or difference between cost and purchase price to that employee has to be included in their wages, and since that spread is added to their cost, then their cost is usually equal to or slightly greater than the sales price. And so they'll end up actually reporting losses when they file their tax return. So here we have a 1099-B showing a cost of $73,953.11 made up of these separate transactions. And under IRS rules, we have to report those transactions on Schedule D as short-term capital losses. And the reason they're short-term is they were held for less than a year. And actually the rule for this particular form on Part 1 is 1 year or less. So if you hold them for a few hours or a few days, you definitely have short term. We're matching up each of these sales transactions quantity-wise with what we're seeing on the 1099-B. And then we're entering the sales price to match up with what we see on the 1099B. So the total short-term sales price amounts should be an exact match to the sales price amounts shown on the 1099B, or higher. You don't ever want them to be lower, because if they're lower, your client will get a letter. It is possible for them to be higher. For example, perhaps your client has short-term sales that are reported on a 1099B, but they also have other short-term sales that are not reported on a 1099B. Well, then you would have a situation where the number in Box 3 of Schedule D could be higher than the amount shown on the 1099Bs, but it should never be less. The next part is to go and look up the cost. Well, the cost basis to tech employee on each of these stocks is the amount that he paid plus the amount included in his income as wages. So ultimately, the cost that we show here for this employee balances out to the cost that we're showing here. So here's the cost in the $9.99. Here's the cost in the $12.75. So that $29,970 for 999 shares, that's the amount we're going to enter. And there's the $29,970, you see? So each of those costs that we figured out earlier in Part 1 of the problem, we enter those. And then we compare those against the 1099B, and when we're done with that, ultimately, tech employee has small losses. He ends up with net short-term losses of $224. So ESPPs and ISOs held for a few days. When the stock is sold within a few days of purchase, it usually results in a small loss or a small gain. On a same-day sale for ESPPs and ISOs, when the stock is sold on the same day as it is purchased, it usually results in a loss equal to the amount of the transaction fees and commissions. Part 3 of the illustration. So I've given you a lot of different information to try and figure out cost basis. But the bottom line behind all of this is you're still trying to track it down to hard numbers that you can find. And one of the ways to do that is to look at a year-end pay stub for the employee. Obtaining a year-end breakdown of a taxpayer's W-2 income is useful for purposes of balancing the Form 1099-B to the tax return. Using the year-end payroll summary makes it possible to balance the ESPP and NQO compensation income of an employee against the 1099-B statement and helps to ensure accurate basis calculation when reporting the sale of ESPP and NQO shares. So tech employees' year-end payroll summary might look like this one. So we have base salary for the employee, vacation pay, sick pay. This employee also had an RSU, and you don't even know what that is. I haven't explained it yet. And the ESPP and the NQO. So you could have all of these different sources of income in the year, arriving at a total pay of $78,224.86. But then we have some deductions that came off of that, 401k and life insurance. So we have total deductions coming out of payroll of $7,854.60. That leaves us with net payroll wages of $70,428.26, and Box 3 wages of $76,121. So on this Box 3 wages, we have the gross pay up here minus the SPP profit. And on the Box 1 wages, we have all of the income minus the 401k contribution. So finally today I wanted to discuss two more kinds of employee stock arrangements. They're not ISOs, and they're also not ESPPs. There's something new again. Maybe not necessarily new, but newly popular. And the less popular of these two items is the restricted stock award, which we will talk about first. Restricted stock awards are a method by which companies reward employees with stock, but retain the right to force the return of the stock if an employee does not meet certain preset requirements. With RSAs, a company awards an employee a number of shares of the company's stock, subject to vesting restrictions, such as a requirement that the employee remain at the company for 1 year before the award will vest. These are the important RSA facts you should know. The employee becomes the owner of the shares before they are vested and is entitled to vote and receive dividends on those shares. But if the shares don't vest, the company has the right to cancel the award. The vesting of the RSA typically creates a taxable event for the employee who must either provide outside cash to pay taxes owed on the transfer or sell some shares back to the company or on the market. The employee will then own the remaining shares. Note, often the company will gross up wages on the W-2 with additional compensation to cover the tax consequences. The employee's interests in RSAs are aligned with other shareholders, so when the company's stock goes down in value, the employee suffers along with the company's other shareholders. Let's compare RSAs with RSUs, which are the more common item, and actually they're becoming increasingly popular as, again, ISOs fade from popularity and are replaced with ESPPs and RSUs. Restricted stock units are a form of compensation used by companies to reward employees who provide certain services or reach certain milestones. RSUs have increased in popularity in recent years as many companies move away from stock options in favor of RSUs. An employee who is awarded RSUs obtains a right to receive shares of stock when the RSUs become vested. Upon vesting, the company issues the shares and the recipient then becomes a shareholder. RSUs are different than RSAs because the employee does not receive ownership of the stock until it is vested. Most large companies like RSU programs because they are easy to administer and ensure that employees are only entitled to dividends and voting rights on vested shares. If you receive stock or other property that has certain restrictions that affect its value, you do not include the value of the property in your income until it has been substantially vested. You can choose to include the value of the property in your income in the year it is transferred to you rather than the year it is substantially vested. You should see Publication 525 for instructions on this. Until an RSU becomes substantially vested, it is not owned by you and continues to be the property of your employer. When the property becomes substantially vested, you must include its fair market value minus any amount you paid for it in your income for that year. Your holding period for this property begins when the property becomes substantially vested. So when do RSUs vest? Depending on your company's plan rules, vesting requirements may be met by the passage of time or company or employee performance. If an employee does not meet the requirements set forth by the employer prior to the end of the vesting period, the units are typically forfeited to the company. Some companies may allow vesting prior to the vesting date, contingent upon company satisfaction with a particular employee's compliance with criteria set forth in company plans. So what all is going on here, or what is this talking about? Well, you could work for a company, and that company likes you, wants to keep you, wants to give you an incentive to stay on and not move over to some other company. So they say, if you stick with us long enough, we're going to give you 1,000 shares in our company. And so you're going, well, if I stick with them for a full year, I'm going to get 1,000 shares. So that's an incentive to stay on. And so if the employee does stay on, then the day will come where the fulfillment of that requirement is made, and the company will then vest the stock to that employee. Now, what happens when the RSUs do vest to that employee? Well, once RSUs are vested, an employee's rights to vested stock units become non-forfeitable. At vesting, the employee will receive actual payment according to the distribution schedule under the company's plan. In some cases, an employee may elect to defer distribution. If an employee does not elect to defer distribution, then the distribution date and the vesting date are the same. Tax payments are due at vesting. So once RSU shares have been vested, an employee may be required to pay statutory minimum taxes. If distribution of shares is deferred, an employee may defer some of the statutory taxes until distribution does occur. So how are taxes on restricted stock units paid? Depending on the plan rules for each company, there are usually two options which can be used to pay withholding taxes due to IRS at the time the shares are vested. There is the net shares vested, which in my experience is pretty much all I ever see, but there is also a pay cash option, which I've never had a client take advantage of. But let's talk about net shares first. An employee who elects to net shares will sell enough shares to the employer or have the employer withhold to pay the tax withholding obligations. The employee retains the number of shares vested less the number of shares withheld for tax purposes. Under the pay cash method, an employee who elects to pay cash to satisfy tax withholding obligations must provide cash to the employer on the day of vesting. The money is used by the employer to pay the required payroll and withholding taxes. So here is a net shares example. Ralph had 100 RSU shares vested to him by his employer on April 1st. The market price of the stock on that day was $60, and his combined income tax and payroll tax withholding rate was 40%. Ralph's employer will include the following income on his W-2. 100 shares times $60 is $6,000, but then Ralph's employer will sell 40 shares to pay the withholding taxes that Ralph owes on all of the RSUs. So 40 times $60 is $2,400 of shares are sold off. At the end of the year, Ralph will get a W-2 that shows the following amounts. Box 1 wages that have been increased by $6,000 and withholding taxes that have been paid by $2,400. Ralph now owns the remaining 60 shares, and his cost in his remaining shares is $60 a share, or $3,600 for all 60 shares. So in essence, he started with 100, but to not have to pay taxes on the 100 shares, 40 of those shares were sold off, and the money from those 40 shares, in fact, paid the taxes he owed on all 100 shares. So in the end, he's paid $2,400 of tax, and he has 60 shares left to show for it. And here is the pay cash, but far less common example. Sydney had 100 RSUs vested to her by her employer on June 1, 2010. The market price of the stock on that day was $40, and the combined income tax and payroll tax withholdings rate is 40%. The total amount of the vesting is $4,000, or 100 shares times $40 a share, and the total withholding tax owed is therefore $1,600. That's 40% of $4,000. Sydney decides to give her employer $1,600 to pay the withholding tax on the RSU vesting. That way she'll own all 100 shares rather than only the remaining shares left if her employer sold some to pay the tax instead. Sydney's employer will transfer all 100 shares to Sydney and issue a year-end W-2 which shows the following amounts. Box 1 wages will be increased by $4,000, and the withholding taxes will be increased by $1,600. Sydney now owns all 100 shares. Her cost in her shares is $40 per share, or $4,000 for all 100 shares. Other reporting requirements affecting RSUs. Reporting methods used by employers can vary. However, most RSU vestings are reported only on the W-2. 1099-Bs are normally not issued to report the portion of the RSUs that are withheld to pay withholdings taxes. Ralph and Sydney should make note of the closing price on the vesting date because this is the basis they have in their remaining shares. So what does happen when the RSUs are sold? Well, once they are fully vested, the holding period and capital gain rules for RSUs are the same as they are for any other kind of stock. Short-term and long-term capital gain and loss rules apply depending on how long the shares are held and whether they are sold at a gain or loss. And here is our second password of the day. This password is password number 2, not associated with the test, and the password is national, N-A-T-I-O-N-A-L. And here is the classwork assignment for the day. There are no tax forms to fill out today. Really, basis of assets is all about figuring numbers, but not about filling out forms. You fill out forms when you sell stuff, but just when you purchase property or acquire property, there's no form filling. So your classwork assignment today is going to be to calculate cost basis, wage income, and capital gain for each of the following sales. And we essentially have a qualifying ISO sale and a non-qualifying ISO sale. We want you to go through and figure out what the cost basis is in these situations. In the first one, Seska is granted 200 shares of Nistrum stock options at $50 per share on 7/13/08. She purchased the option on 1/10/09 when they were trading for $60 a share. She sells the options on 8/23/2010 for $65 a share. So your job is to take that information and figure out what is Seska's basis in her shares, how much will she report as wage income, and how much income will she report as capital gain income. Classwork assignment 1B, the non-qualifying ISO sale. Kim is granted 100 Voyager Inc. shares on 7/13/2008 for $40 a share. He exercises the shares on 1/20/2009 when they are trading for $45 a share. He then sells them on 4/23/10 for $70 a share. Now we have the same three questions. What is Kim's basis in his shares? How much will he report as wage income, and how much will he report as capital gain income? So at this point, please push pause on video playback. Complete classwork assignment number 1. And when you are finished figuring cost basis answers for Seska and Kim, please resume video playback for a review of classwork number 1. So I have up in front of you now the classwork answer key for classwork 1A, and I've just got it open on the screen right next to the questions themselves. So how do we go about figuring this transaction for Seska? She gets 200 Nystrom stock option shares at $50 a share, and the date is 7/13 of 08. She purchased the option on 1/10 of 09, and then she sells on 8/23 of 10. So 8/23 of 10 is more than a year after the date that she purchases, and it is more than 2 years after the grant date. So we know she has a qualifying ISO sale. So what's next? Well, we know that because she has a qualifying ISO sale, there's no wage income to report at all. So her capital gain is essentially going to be the difference between what she pays and what she sells for it. And in this case, we have 200 Nystrom shares times $50. That gives us a cost of $10,000. $50 a share times 200 shares gives us a cost of $10,000. So how much will she report as wage income? Well, the answer is nothing, because this is a qualifying ISO sale. Nothing gets reported as wage income. And what is her capital gain? Well, she sells for $65 a share. She sells 200 shares. 200 times $65 is $13,000, so she sells for $13. She paid $10. That gives her a capital gain to report of $3,000. Moving on to classwork 1B. Kim is granted 100 Voyager shares on 7/13 of 08 for $40 a share. He exercises on 1/20 of 09 for $45 a share, and then he sells on 4/23 of 10 for $70 a share. He owns the stock for more than a year, but his holding period does not extend more than 2 years after the grant date, so this is a non-qualifying sale. If you look, 4/23 of 10 is not more than 2 years after this date. It is less than 2 years after this date. So essentially, he has a non-qualifying sale, and because he has a non-qualifying sale, he's going to have a gross up in his wages. The gross up in his wages is going to be the difference between what he pays and what the shares are worth on the day he purchases. If he purchases 100 shares for $40 a share, when they're really worth $45 a share, he has a spread of $5 a share. 5 times 100 is $500. And that $500 is the amount that's going to be added to his wage income. And what is his cost basis in the shares? Well, that's going to make his cost basis $45 a share. There's the $500 that was grossed up into his income, plus the $4,000 he paid for the shares. So what is his basis in his shares? Well, that's going to be $4,500. And what will he report as capital gain income? Well, he's going to have 70 times 100 shares, or $7,000, minus $4,500 is going to give you his gain. So we have his cost basis is $4,500. The amount included in his W-2 is $500, and his profit on the sale is going to be $7,000 sales price minus his cost basis of $4,500. So the correct answer to number 6 is $2,500. Let's take a look next at classwork assignment number 2. And number 2 is a variety of different problems we've asked you to figure your way through and select the correct answer. John Zeller is an employee of First Tech Corp. Inc., and during the year he exercised his right to buy 200 shares of non-qualified stock options in Tech Corp. for $48 per share. The stock had a fair market value of $82 a share at that time. Assuming John's annual salary is $80,000 for the year, calculate the total amount of income Tech Corp. Inc. should report as wages on John's W-2. Well, I'm going to help you figure problem number 1, and then I'm going to leave you on your own to do the rest of classwork assignment number 2. So again, what we're looking at is it had a fair market value of $82. He's exercising, though, for only $48 a share, so we're going to go 82 minus 48, which gives us $34 a share. How many shares? 200. The amount, therefore, to add to his W-2 is going to be $6,800. If his salary is $80,000 for the year, you would be looking to see that he has a W-2 at the end of the year showing $86,800 of wages paid. And here is that calculation. We got the fair market value on the issue date, the exercise price he paid, the difference is 34. You multiply that by the number of shares, and you get $6,800. You add that to his base salary, and you get net wages that you should be looking for in his W-2 of $86,800. So for Classwork 2, problem number 2, we've got another scenario. This one involves Mary, who inherited AT&T shares from her mother, Martha. Go ahead and read through the remaining problems that are a part of Classwork Assignment 2, and then complete those Classwork assignments. So please push pause at this point, complete Classwork number 2, and when you are finished completing Classwork number 2, please resume video playback, and I will review the Classwork 2 answer key with you. So at this point, you should have taken some time to muddle through this second part of Classwork number 2. It's asking you to really think about the information that I gave you in today's lecture. So let's take a look at what happens with Classwork assignment number 2. Mary inherits 2,500 shares of AT&T stock from her mother, Martha. And we give you information on when Martha bought the stock, how much she paid for it. That's not relevant when it comes to an inheritance. What we care about with an inheritance is what it was trading for on the date of death. So if we scroll through the course manual, we come to the AT&T trade price on the date of Martha's death. We had a high price of $26 a share and a low price of $25.91 a share. Now, where did we get this information? Because this is actual hardcore information about what AT&T traded for back on 4/1 of 2010. Well, let's go to the internet and find it. So I went to the AT&T website, and I just did a search engine for AT&T shareholder services, and I arrived on this site. And then what I look for is, basically information on stock, and here we have historical quotes, so I clicked on that. Then I scroll down the screen, and I come to price lookup, select a date. So this is where I entered 2010. We went with April 1st, and click submit. And when we do that, we get this exact same information, high 26.21, low of 25.91. So that's where we got the information that we inserted in the manual. And anytime you want to find cost in stock or the value of stock on a particular day, you can either go to bigcharts.com or you can go to the shareholder website for that particular company. So let's see what all of this means. What is going to be the cost basis in the stock that Mary has inherited from her mother? Well, it's a very simple calculation, actually, and here is the answer. Because Mary received her shares of AT&T stock as an inheritance, she uses the fair market value of the stock on her mother's date of death to establish cost basis. The IRS rules require Mary to use the average price on the date of death for calculating cost basis as follows. We take the high price of $26.21, the low price of $25.91, and then we add those two numbers together, divide them by 2, and we get the average of the high and low price, which is $26.06 per share. We then multiply that average trade price on the date of death by the number of shares held on the date of death, and when we do that, 2,500 times $26.06 is a total tax basis in the AT&T stock of $65,150. So go moving down to the next page of our problem. It was a multiple choice question. What is the correct answer? Well, the correct answer was $65,150. The next question is, without regard to any gift tax adjustments, what would Mary's basis in the AT&T stock be if she had received the stock as a gift from Martha rather than as an inheritance? Well, we gave you some more information from the AT&T website to help you with that. And that's this graph right here, the AT&T adjusted basis worksheet. And I'm going to show you how you can find that and make it work for yourself. But let's go back up to the wording of the problem. Martha purchased the AT&T stock on 7/3 of 85 at a cost of $6.97 per share. She did not reinvest any dividend income. Okay, well, let's go to the AT&T website and see what we can do to figure this one out. So AT&T has a cost basis guide. I clicked on that, and then I selected AT&T Inc., and here's where it asks me in the worksheet, enter the original cost per share, which was $6.97 per share. Then it says, click here if you owned the stock, the AT&T shares, before January 1, 1984. Well, no, Mary bought them on 7/3 of 85. So we go to the next one. Click here if you acquired the AT&T shares after January 1 of 84, but before May 22 of 1987. Well, that would be Mary. So we click on it. And as soon as we do that, it fills in these fields. And what those fields serve a purpose for is that there were splits, and these splits have served to reduce Mary's basis in the stock. So the first split was a 3-for-1 split. It reduced her cost per share from $6.97 down to $2.32. The second split was 2-for-1, and that reduced the remaining basis from $2.32 a share down to $1.16. And after that, there was another 2-for-1 split that took her from $1.16 to 58 cents per share. So what all of this means is that early on when she first bought those shares, she would have purchased, and this is kind of just mathematical deduction, she would have originally purchased 416.67 shares. Because if you take 416.67, multiply that by 3, multiply it by 2, and multiply it by 2 again, you're back up to 2,500 shares that she held when she died. So it's just some interesting stuff that is going on there. So what you have to remember is that a person may buy fewer shares than they actually ultimately hold at a later date, and the reason for that is splits. And shareholder websites such as this one can be very useful in telling you when those splits occurred. Going back to our manual then, and I essentially told you this historical split data, that there was on May 22 of 87 a 3-for-1, in 1993 there was a 2-for-1, in 1998 there was a 2-for-1. You're going to use all of that information to figure her cost basis. Well, the AT&T website already showed us that we got down to 58 cents per share. So what that means is that if Mary receives the shares as a gift from her mother, she's going to have to go to her mother's cost. And her mother's cost was $6.97 per share. But because of all of the splits, the actual net cost per share is only 58 cents. She's going to own 2,500 shares at a cost of 58 cents each. So if you take 2,500 shares, multiply that by 58 cents a share, you get $1,450, which is the correct answer. So just going here and referencing the answer key, on 4/1 of 2010, Martha's adjusted basis was 58 cents per share, and the fair market value of AT&T was $39.32 per share. So under the gift rules, we go with the lesser of the fair market value or the donor's adjusted basis. And the donor's adjusted basis is only 58 cents per share. And so since the fair market value is more than the basis, Mary's basis is the same as her mother's basis, we therefore calculate Martha's basis in the AT&T stock as follows. We go with the purchase price of $6.97, we divide that by 3, we divide that by 2, we divide it by 2 again. And then we're left with the total number of shares held. Based on these calculations, we end up with a cost of 58 cents per share times 2,500 shares. That gives us $1,450. And on to number 4. For investment purposes, Alan purchased a vacant lot in 2006 for $80,000. Alan made the election to capitalize his interest in taxes and has not deducted property taxes or mortgage interest that he paid on the property. His property taxes were $400 in 2006, $600 in 2007, $700 in 2008, $750 in 2009, $850 in 2010, and then he also paid $10,480 of interest on the loan he took out to acquire the property. Finally, he also paid a lawyer $700 to defend his right to the property. Because the economy has taken a turn for the worse, Alan's property is only worth $75,000 today. What is his cost? Well, his cost is essentially what he paid for it plus all of these other amounts. So we have the purchase price of the property, $8,000, the accumulated property taxes that he paid of $3,300, the mortgage interest that he paid, the legal fees. So his total cost basis is $94,480, which was answer number D. The final password of the day is the password to open the Classwork answer key. That password is MORAB, which is spelled M-O-R-A-B. Your homework assignment is asking you to figure Angela's basis in her IRA and a number of other multiple choice type questions. So I'm going to leave you to read these on your own as your homework assignment. It should be a relatively straightforward assignment, but still somewhat challenging for you. And that, therefore, is the conclusion of Session 13. Thank you for participating. I will see you again back at the beginning of Session 14, where we will begin the session with a review of the homework answer key. And then we will move on to the Session 14 lecture, which involves depreciation. One of my favorite topics, but usually one of the least favorite topics of my students. Thank you, and bye-bye.